Hey everyone, welcome to Blockchain of Ra. Before we dive in, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Welcome back, ladies and gentlemen. This one's going to be wild. Over the past few days, we've been tracking something, a pattern, a movement, a shadow in the data that points directly at Binance, and what I believe could be one of the most coordinated liquidity plays we've ever seen involving XRP. Now, unless you've been living off-grid, you've probably noticed it. The wild, almost unnatural volatility that hit the market out of nowhere. XRP crashing down to A110 before ripping back up. Bitcoin dipping below 100,000 hours, billions wiped out, and then suddenly, just as suddenly, billions reappeared. People called it chaos. Others said it was just a correction. But I've been in this space long enough to know nothing like that happens by accident. And the deeper we looked, the clearer it became. This wasn't a random event. This was engineered. Think of what happened like the Great Fire of Rome. Everyone pointed fingers at the chaos, but behind the flames there were people benefiting. The same thing just happened in crypto. While retail traders were panicking, accounts linked to whales and insiders were quietly positioning themselves, and the profits they made weren't in the millions. They were in the hundreds of millions. And who sits right at the heart of this? Binance, the exchange that controls more liquidity, more order books, and more trading pairs than anyone else on the planet. Now, before we go any further, let me be clear. We're not here to spread fear. We're here to show you the data. Because when you follow the trail of liquidity, when you trace the timing of the shorts and the API halts, when you overlay with announcements, outages, and chart behavior, it tells a story. And that story is dark. Let's rewind for a second. During that 24-hour window, more than 16 billion worth of long positions were liquidated. That's not just volatility. That's a record-breaking liquidation cascade, the biggest we've ever seen in crypto history. But here's the part that no one's talking about. While those positions were getting wiped out, Binance internal systems, their matching engine, their API started experiencing heavy load. Traders couldn't log in. Orders froze mid-execution. People couldn't even close their positions. Sound familiar? It should, because this same pattern has played out before in traditional finance. Back in 1929, during the stock market crash, retail investors were locked out of trading floors while insiders dumped positions. In 2008, the same thing happened digitally. Markets halted while hedge funds repositioned. Different century, same playbook. And when Binance finally made a statement, they said, quote, "Due to high market activity, some users may experience delays. Funds are safe. Funds are safe. Tell that to the thousands of traders whose positions were liquidated while the market conveniently froze. Tell that to the people who watched their portfolios evaporate, unable to click a single button." I want you to remember this line because by the end of this video, you'll understand why that statement might be one of the most misleading phrases ever put out by a crypto exchange. So here's what we're going to do today. We're going to break down exactly how Binance's XRP liquidity system works, how they could have stopped the collapse but didn't, why their inaction may have profited them massively, and what this means for every single person in the crypto market right now. Because make no mistake, this wasn't a simple crash. This was a calculated reset. This was the dark XRP strategy. Now, let's start with what actually happened on the blockchain that day. When we started tracing the data, the first thing that stood out was the timing. Every major price drop in XRP within that window happened within seconds of Binance's API throttle messages. Seconds, that's not coincidence. That's synchronization. You can almost visualize it. Instant liquidity vanishes. Prices nosedive. Retail traders get frozen out. And then mysteriously, liquidity returns when the price hits rock bottom. If you've ever studied market microstructure, you know what that means. Someone's controlling the tap. And the analogy I keep coming back to is the Hunt brothers silver squeeze of 1980. They cornered the market on silver, driving up prices nearly tenfold until regulators changed margin requirements overnight, forcing a total collapse. Billions were lost, but not by the Hunts. They cashed out early. Sound familiar? Different asset, same tactics. Let's talk about what Binance could have done because that's the one question no one's asking. At the dominant exchange, Binance has every assets tool that every stock exchange on Wall Street uses daily: proactive trading halts, dynamic margin heights, and circuit breakers. These aren't just fancy terms. That the lifeboats that prevent exactly what happened to XRP. A proactive trading halt temporarily freezes all trades when a coin's price movement becomes predefined threshold. It gives the system a few minutes to breathe, recalibrates, or let data sink before a full-blown cascade wipes out billions. New York Stock Exchange does it, Tokyo Exchange does it, but Binance? Nothing. Crickets. Then there's dynamic margin heights, automatic increases in collateral requirements as volatility spikes. It prevents over-leveraged longs from toppling the market like dominoes. Yet, Binance didn't raise margins until hours after the collapse when the damage was done. And the third circuit breakers are supposed to stop exactly the kind of algorithmic chaos we just saw. In traditional finance, a 7% drop triggers a 15-minute pause. In crypto, you can drop 70% in 15 minutes and nobody blinks. Now, some people will argue, well, crypto is supposed to be centralized. No one should halt the markets. Sure, in theory, but let's be honest. When one exchange controls 70% of global liquidity across spot and futures markets, that's not decentralization, that's monopoly. Binance isn't a bystander. It's the central bank of crypto. And when the central bank sits back while 16 billion longs gets liquidated, you have to ask yourself, was this incompetence or intent? Because here's where it gets dark. During that same hour, on-chain trackers identified massive short positions being opened, not randomly, but systematically minutes before the crash began. And guess where the majority of that volume came from? Address is tied to Binance's market-making partners. That's not speculation, that's public data. The blockchain doesn't lie. Let me give you a visual analogy. Imagine you're on a ship and Binance is the captain. Everyone on board, traders, investors, altcoins, they're all passengers. Suddenly, the ship tilts 80 degrees. Water floods in, alarms go off, people are panicking, they're trying to reach the lifeboats, but the captain, he locks the doors to prevent crowding. By the time they reopen, half the passengers are gone. And the captain calmly says, "Everything's fine. Please remain patient." That's exactly what happened. I've talked to traders who tried to log in during the collapse, people who had stop losses set, positions ready to close, but couldn't even get to the site to load. Now, some could log in, but charts wouldn't render. Others could see their liquidation warnings, but couldn't click close. It's the same story over and over again. And that's when it hit me. This wasn't chaos, it was chirography, just like the London gold. Fixing in 1960s when a handful of banks secretly decided daily gold prices behind closed doors. Binance and its partners are effectively deciding crypto's volatility schedule. They can pull liquidity, trigger cascading margin calls, and then re-inject liquidity all within minutes, harvesting profit from both ends. And guess who loses every single time? You, me, every retail trader who doesn't have the luxury of inside latency. Now, I want to address Binance's statement again, not because it's not just corporate fillers, it's a shield when they say funds are safe. That line technically means the exchange's cold wallets are fine. But what about your funds, your positions? If your entire portfolio is liquidated due to manipulated volatility, your funds aren't safe. They're transferred. Transferred where? To the same institutional players who opened 9-figure shorts minutes before the crash, to the same liquidity pools that mysteriously swell seconds after XRP. Bottoms out. This isn't decentralization, it's digitized feudalism. The kings are the exchanges and the peasants are the traders providing liquidity for their game. Let me give you another parallel. The 2008 subprime mortgage crisis. Remember how the big banks bundled toxic loans, sold them to the public, then shorted their own products before the crash? That's eerily similar to what we're seeing now. Exchange-listed high-leverage tokens, encouraging overtrading with flashy bonuses, and then when the volatility hits, they profit off the liquidation engine they built. It's the perfect trap. They create the game, set the rules, and profit when you lose. And the scariest part, we've normalized it. We've accepted exchange outages as part of the crypto experience. We laugh about getting liquidated as if it's just bad luck. But if any other markets, this would be a global financial scandal. If this happened on Wall Street, the SEC would have been in court the next morning. If it happened in Tokyo, there would be resignations before sunrise. But in crypto, we got a tweet. Funds are safe. You see, history repeats itself because the players never change. Only the tools do. In the 1600s, it was Tula bulls in Amsterdam. In the 1920s, it was stocks. In 2008, it was mortgage-backed securities. And in 2025, it's crypto liquidity. Different era, same greed. So what does this mean for XRP holders right now? Why would Binance rip reputation regulation pull off something like this? And most importantly, what's coming next? That's exactly what we're breaking down next. Because this dark strategy wasn't just about profit, it was about control. Up and up next, I'll show you how these manipulations tie into Binance's XRP liquidity pools, the timing of political announcements, and the patterns repeating across other altcoins. Because once you see the full web, you'll realize this was never just about XRP. It's about the future of every coin in your portfolio. When you connect the dots, a pattern starts to form. Every surge, every dip, every unexpected outage aligns like constellations on a map, and they'll all orbit one massive center of gravity, liquidity control. Now, I'm not saying Binance is sitting in the dark room flipping a switch. But if you look at the other on-chain timings, the futures order books, and the throttling of access during key volatility spikes, you'll start to see something that resembles a system running exactly as designed. The hidden engine. Think of the modern crypto market as a high-frequency battlefield. Algorithms trade in microseconds. AI bots react faster than a blink. And the smallest delay, even a two-conned API lag, can mean millions gained or lost. So when access suddenly slows down for retail traders while institution nodes keep humming, it doesn't just look unfair, it looks engineered. It's a 21st century echo of the New York Stock Exchange specialists in the 1930s who could halt the floor at will, giving insiders a breather while the public drowned in volatility. Back then, it took decades for the system to self-correct. Today, those are the same dynamics compressed into milliseconds and magnified by code. Control versus chaos. Why does this matter? Because control of liquidity is control of the narrative. If a few entities can dictate when volume vanishes or floods, they can write the emotional script of the entire market. Fear, panic, euphoria, repeat. It's digital theater, and most of us are extras on the stage. You see in the candle charts sudden crashes that rebound perfectly like a heartbeat on a monitor. Markets don't move that neatly on their own. Nature is messy, manipulation is symmetrical, and history warns us about this rhyme again and again. The tulip mania ended with liquidity vanished overnight. The Great Depression began with banks' closed doors for stability. 2008 crisis unfolded when leverage met opacity. Different centuries, same lesson. When power centralizes around liquidity, chaos follows. The ripple effect. XRP's crash and rebound was a case study. Billions evaporated in hours, yet total market capitalization recovered almost instantly. That means value didn't disappear, it was transferred. Some analysts believe that this transfer isn't accidental. When retail traders are locked out and liquidation triggers, counterparties collect. It's not a conspiracy theory. It's just how leverage markets function when unchecked. And that's why regulation debates are heating up. Governments aren't just chasing taxes. They're realizing that unregulated liquidity giants now move national economies the way central banks once did. So here's the turning point. Here's where things get truly unsettling. Since that crash, smaller exchanges have quietly started mirroring Binance's liquidity architecture. They call it efficiency. I call it replication of control. If this pattern continues, the same handful of engines could end up orchestrating nearly every major coin's price movement. Crypto was born to be free of centralization. Yet, step by step, it's walking back into it. That's the irony of innovation. The faster it grows, the quicker we forget it ever existed. The warning. So, where does this leave us? If you hold XRP, Bitcoin, Ethereum, any digital asset, remember this. Volatility isn't random noise. It's a language. And right now, that language is being written by whoever controls the flow of liquidity. Markets don't crash for no reason. They crash to transfer energy from the many to the few, from fear to profit, from decentralization to dominance. But the knowledge is leverage. The moment you understand the mechanics, the halts, the cascades, the engineered panic, you're no longer the pawn. That's why we make these videos, even when it's risky. Because the first step is to take power back as knowing how it was taken from you in the first place. Crypto doesn't have to repeat the mistakes of history. If communities demand transparency, open source matching engines, verifiable audit trails, real-time liquidity data, the system can evolve. But if we keep ignoring the patterns, and someday we'll look back on this era the same way people look back at 2008, 1929, and 1637, wondering how come no one saw it. We're not here to tell you to sell, to buy, or to panic. We're here to tell you to pay attention because in markets built on trustless technology, the greatest risk is still the same as it was in every empire, every bubble, every crash, trusting the wrong people. This opened your eyes. Smash that like button, ring the bell, leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Republic, bringing you the truth about XRP Global. Banking moves and the wealth transfer already unfolding. Don't just watch history happen, stay informed, stay ahead.